Welcome to another week of Ben's Market Insights. This week we're going to be talking about the big results coming through on Wednesday after market from Intel and from Google, and we'll talk about that a little bit more. On a macro level, the ECB is going to be announcing its latest rate assumptions. We don't think that they can raise from the current 2.25% or lower for that matter. They're pretty much stuck because the inflationary pressure remains in Europe. From a perspective of the UK, we see CPI numbers coming through this week. Probably headline uptick towards 2.8% is where consensus has it. I suspect that we're probably going to continue to see that staying relatively high, really holding the Bank of England either at rates where they are or potentially even having to raise rates before year end. And that is something that I think consensus is probably not on board with right now. And finally, in the US, from a perspective again of inflationary pressure, we're really not seeing any kind of end to this Iran-US feud at this juncture. Can't see how it sort of stops. The negotiations are not really achieving anything or any outcome. So expect energy prices to remain relatively lofty. That keeps the Fed's hand on hold as far as interest rates are concerned. That means that US 10-year yields will remain at 4.5%, if not even higher percentage points. Keeps inflation relatively high. And from the perspective that we will see no rate declines for some time to come, I suspect that certainly is the standard that we should expect. On the other hand, there is a steepening in the yield curve, which is good news for financials. And as we discussed last week, they did come through with very strong results, and I suspect the momentum remains in the financial sector going forward for a little bit longer. Now, coming back to the Google results out on Wednesday, the expectations are for a 24% increase in earnings year on year, that cloud revenues will be increasing some 60 to 70%. So pretty punchy numbers out there right now. Any disappointment will clearly be very negative for both Google and the general technology space to boot on top of that. What are we likely to see here? Well, I think the key element is that there is a guidance for CapEx for this year, which has been maintained throughout by management at around $175 to $190 billion. Management have said that we're going to see a significantly higher number going into next year. Now, I think that this is where we'll probably see a change. I don't think we'll see a change to the guidance for this year, but certainly that much bigger number that they were suggesting for next year is likely to be tempered this time around. And that, I think, will drive some really interesting performance, negative performance in the semiconductor and hardware space. Maybe, and just maybe, with the SOX, which is the semiconductor index, down some 20% from its highs since June, that momentum continues. But at the same time that the hyperscalers, if they start to suggest that they're going to hold back a little bit, maybe that's a very interesting long-short play with hyperscalers against the semiconductors. Certainly that condition is in place today and might get exaggerated, if you like, if Google do say anything about that 27 CapEx. Just to keep in mind that it's not all plain sailing for these hyperscalers. Costs continue to appreciate significantly. Energy prices, so let's kind of just step back a little bit here and see that AI data center energy requirement is some 5 to 10 times that of a conventional cloud storage facility. And that means that in order for somebody like a Google, who has not only got to find more energy, but has a neutral carbon footprint mandate in place for itself, means it has to go and sign significantly more expensive energy contracts, long-term energy contracts, both in alternative energy and new nuclear type of power base as well. So far, we've seen almost a doubling in the cost associated with this AI spend since 2024 for Google. But also at the same time, we're seeing a non-cash cost item rising as well, very significantly, and that's depreciation. We covered this a few weeks ago around the lifespan of a GPU, and what we are seeing now is that the obsolescence level is actually shortening because there's a significant usage of these GPUs, and so we're going down from some 6 years to 4 years. That has a big impact on operating profit and margin through the depreciation cost going higher. Now, analysts continue to see the current 32% operating margin heading towards 35% over the next couple of years. Now, even if we do see, and we have to see, some kind of indication that revenues are beginning to come through from this AI spend, we also at the same time need to see a significantly lower cost assumptions, or rather higher cost assumptions from analysts in order to get to that 35% operating margin expectation. So a lot riding on these numbers, a lot more I think this time on these Q2 numbers than there were on the Q1 for 26. And so I think that when we put all that together and we consider that also in the week after next, we start to see results from Microsoft, who are spending $190 billion this year, and Amazon, who are spending $200 billion this year, we get a feel that there really has to be some good news out there. Just in terms of, we did some analysis around who is the most resilient in terms of their other businesses in providing the cash flow required for this AI spend and taking on board these increasing costs coming from both everything from overhead to energy to depreciation. And in terms of the league table, Microsoft comes through as the most resilient free cash flow generator, followed by Alphabet, and then lastly by Amazon, given that the merchant part of the Amazon business carries a much smaller margin, and so therefore the ability to compensate for any reduction or increase in cost is much harder at Amazon than it is with the other two hyperscalers. By the way, if you're enjoying this content, please give us a subscribe to the channel, Ben's Market Chat, and give us a thumbs up and a like. Thank you very much indeed. Just a broader look in terms of the EPS growth expectations for this second quarter. Consensus has US at some 26% year-on-year EPS growth. That's pretty punchy. Europe is on about 16%, and much of that's actually the best in about 3 years of quarters out of Europe. Much of that is coming from the oil majors in Europe, who are obviously getting a huge benefit from the uptick in energy prices thanks to the Iran war. So for me, that's relatively transient, and I wouldn't expect that level of earnings growth in Europe to be maintained at this kind of level. I would also add that next week we see results coming through from Amex in the US. That should give us some really interesting perspective, first level perspective on US consumer largely. One of the elements I think we're going to be seeing here is a major polarization in terms of spending habits between those that have and sadly that those that have a lot less, because what we are continuing to see is that the non-discretionary prices continue to move higher, making it very difficult for people to go out and spend money on anything but their essentials. We're also going to be seeing results out of Nestle, and that's the sort of non-discretionary part of the spend, so that should be fairly consistent. And also from SAP, interesting, obviously one of the world's largest supply chain management software enterprises. Is software really dying? Are they beginning to see a decline in revenues, or is AI going to be a major benefit for their business? I think the latter. I think AI will be a significant help for a company like SAP, which is so integrated into so many of the large enterprises. We also see results out of the European pharmaceuticals. Nothing to add there. I suspect that these continue to underperform their US counterparts because the US spend on healthcare and on research is significantly higher than that in Europe. And I'll leave it there because I think that what we're seeing this week is a major news flow that's going to be very significant for performance of those top names and Max 7 and the semiconductor run rate. My feeling is, long and short of it, is that probably we see a slight tempering in the 27 capex that may result in a small decline in the hyperscalers, but a much bigger decline in the semiconductor and hardware space. Have a great week. See you next week.